The AI bubble is here, and tech billionaire bros everywhere are starting to panic. Michael Burry, legendary investor from The Big Short, is reportedly betting over $1 billion that the boom is about to end in a spectacular crash. He believes the gold rush fueling giants like Nvidia and Palantir is nothing more than a classic bubble inflated by trillions of dollars of irrational hype. And honestly, he's not alone. Some of the biggest names in finance are agreeing with him, warning that while the technology is real and here to stay, its market value has become a work of fiction. A correction isn't just coming. The cracks are already starting to show. So does all this sound familiar? Because it should. Because we've been here before. In the late 1990s, the mantra was get big fast. Any company with .com in its name saw stock prices soar, regardless of whether it had a business plan or a single dollar in profit. It was a speculative frenzy that built on the promise of a new digital frontier. Today, .com has just been replaced by AI. So, what is a bubble? Well, a bubble is when asset prices get completely disconnected from their real-world value, driven by hype and herd mentality. Just take a look at the current market. The tech-heavy Nasdaq has seen unprecedented gains, fueled almost all by AI-related stock, or AI-related anything, really. By some of the most reliable long-term measures, stocks are now more expensive than they were at any point in history. The Shiller PE ratio, which compares stock prices to inflation-adjusted earnings over the past decade, is currently at levels only surpassed once during the great .com bubble. So this isn't just enthusiasm. This is dangerous detachment from financial reality. The Bank of England's Financial Policy Committee has issued warnings that equity valuations for AI-focused companies appear stretched. That's just their fancy way of saying this is a bubble. So even more telling that 54% of institutional fund managers, the so-called smart money, now believe that AI stocks are in a bubble. When people who saw the last once-in-a-lifetime collapse coming are betting against this one, it's time to pay attention. The problem isn't that AI isn't powerful or a good tool. Just the opposite. It's very powerful and it's a decently good tool. The problem is that market valuation has become a work of fiction. So, how did we get here and how fragile is this trillion-dollar tower? The cracks in the foundation become terrifyingly clear when you look at these key factors. The chasm between valuation and profits, the self-dealings of the circular economy, and the unsustainable. First, let's talk about the math, because the math is just not mathing. More specifically, the valuation versus profitability gap. The promise of AI is now everywhere, but the profits are not. Let's take OpenAI, for example, the company behind ChatGPT. It's projected to generate over $12.7 billion of revenue in 2025. An impressive number until you learn that the company is nowhere to being profitable and isn't expected to be cash flow positive until 2029. It is burning through cash at an alarming rate, and this isn't unique either. Research has highlighted that a staggering number of generative AI projects fail to deliver any measurable return on investment. One study showed that about 30% of enterprise generative AI projects are expected to stall due to unclear business value. And this is a classic bubble indicator, immense spending chasing phantom returns. So the second part to all this, and probably the most damning part, is the circular economy propping up this whole entire illusion. Much of the so-called growth in the AI sector is not real growth. It's just a handful of tech giants passing the same money back and forth. Here's kind of how it works. A company like Nvidia agrees to invest in a company like OpenAI. OpenAI then uses money to buy billions of dollars worth of chips from Nvidia. In another deal, AMD provides an AI company like OpenAI with stocks, and in returns, that company commits to buying AMD processors. This creates a dizzying feedback loop. The chip makers invest in the AI lab, which then buys the chips, boosting the chip makers' revenue and stock price. Everyone's revenue numbers go up, and it looks like explosive growth. But it's not organic growth. It's a closed system, a financial perpetual motion machine. Analysts have come out against this and have directly compared it to vendor financing schemes from the bust, where companies would lend their own customers so those customers could buy their own products. It's a house of cards where each card is holding up another card. The third and final piece to all this is there's a hardware arms race, a spending boom of historic proportions, basically. So here's what's happening. Tech giants are pouring unprecedented sums into building AI infrastructure. Companies like Microsoft, Google, and Meta have now transformed from software companies into capital investment behemoths, with capital expenditures surging over 20 and even 35% of their revenue in some cases. This level of spending exceeds utility companies like AT&T at the peak of the telecom bubble. To justify spending trillions and investing in AI infrastructure, research from Bryan and Company estimates that the industry would need to generate nearly $2 trillion in annual revenue by 2030. The problem with that? Well, even with all the potential savings from AI, the world is projected to be about 800 billion short of that target. So if history is an indicator of things to come from when things that were, here's a few examples. The railroad boom of the 1800s and the fiber optic build out of the late 90s. They were also fueled by massive capital spending on new infrastructure. In both cases, this led to massive overcapacity, fierce competition, plunging prices, and disastrous returns for those investors who funded everything. The technology was eventually changed the world, but not before wiping out the shareholders who paid for it. We are seeing the exact same pattern today. A frantic rush to build with little regard to eventual return on investment. So a bubble this large doesn't just pop, it explodes, and shrapnel will hit everyone. The consequences will ripple through every corner of the economy. The most immediate and brutal impacts will be on jobs. The tech sector has already seen waves of layoffs, but that'll look like a summer shower compared to the hurricane that's coming. When the funding dries up, thousands of AI startups built on speculative capital and circular deals will evaporate overnight. Their employees, lured by revolutionary work and lucrative stock options, will be left with nothing. The larger tech giants, having poured hundreds of billions into data centers that are no longer profitable, will be forced to massively lay off their employees, their staff, to slash their bloated costs. Then comes the financial devastation. The Nasdaq has added trillions of dollars in market value since the AI boom has begun, with huge portions of that wealth tying up just in a handful of companies. When these stocks collapse, it won't just be the billionaire investors that get hurt. It will be anyone with a 401k, pension fund, or college savings plan. The retirement funds of millions of ordinary Americans will pretty much evaporate overnight. The dot-com burst wiped out nearly $8 trillion of market value. A crash similar to this magnitude today will vaporize the savings and retirement dreams of pretty much a whole entire generation. So how will this look compared to 2008? Well, there's one saving grace in all this, at least for now. Most AI investments has been equity funded, not debt funded. This means that banks are not directly exposed as they were during the subprime mortgage crisis. However, this is quickly changing. As the cost of capital rises, companies are increasingly turning to debt. The more of the system that relies on leverage and opaque circular deals, the greater the risk of failure. One company could trigger a domino effect. But perhaps, in my opinion, the most insidious consequence is the massive misallocation of capital. This represents years of human talent and billions of dollars that could have been spent solving real-world problems and stuff that we can all benefit from, but instead it was funneled into speculative frenzy that is AI. While AI technology itself will undoubtedly survive and emerge out of this will be just a few winners, the economic wreckage left behind will probably take years, if not decades, to clean up. So now the question is not if a correction is coming, but when, and how many people will be left standing when the wreckage finally hits. So let me know what you guys think in the comments, and let me know what you might be trying to do to prepare for this. I might make a few longer videos on this topic and how to better brace yourself for the impact that is potentially coming. Right now, I'm still in the midst of a lot of research because I want to give some good evidence and advice on how to really try to beat this and buffer yourself from it. So let me know what you guys think. Let me know what you guys are doing, and let me know maybe what I should talk about next. So thank you guys so much for watching. Till next time.